Hi, this is Anthony, and welcome back to my show. Let's get right into the topic, the top 6 reasons why CHEGG is not a buy. As I launch in, as always, please click the subscribe button below. It really helps me out and doesn't cost you anything. Thanks so much. This is a textbook rental and educational services company listed on the New York Stock Exchange. Its stock symbol is CHGG. For full disclosure, I do not own any shares, and I doubt that I'll consider buying any shares anytime in the near future. Here's part of the statement from their website. CHEGG is the leading student-first interconnected learning platform which is on-demand, adaptive, personalized, and backed up by a network of human help. It is the smarter way to student, and it is transforming the way millions of students learn by reconnecting the link between learning and earning through tools and services that support students throughout their educational journey. Our mission is simply to help students save time, save money, and get smarter in order to improve the overall return on educational investment. If you look at their Wikipedia article, it states that they are in the physical and digital textbook rental business, but if you look at their investors deck on their website, it explains that they're transitioning away from that. I have a link to their investors page, their investors deck, and their financials in the show notes. Be sure to look over those before making any decisions on buying, selling, or holding the security. So let's look at the reasons I think that this is a problematic stock to invest in. And again, remember, the whole purpose of investing in stocks is to make money. When you buy shares on the secondary market, you're not investing in the company. You're buying shares from somebody else that already owns shares. You're not investing in a dream. You're not investing in a project. You are holding a small percentage of equity in a company, period. So don't fall in love with your stock. Reason one, terrible long-term charts. CHEGG, which comes from a combination of the words chicken and egg, was taken public on November 15, 2013 at $9.13 a share. Now this chart is actually better than many of the terrible charts that I have in my videos. Over the course of approximately 9 years, you would have made a total of 145% return on equity. That comes to roughly 16% annual return. But that's only true if you would have bought it prior to about 2018. For a number of years it flatlined, and there's probably very few people who bought it way back then and who have held on to it through thick and thin. If you look at more recent charts, things do not look so great. Here's a 5-year chart which takes into account the current bear market that we're in, but also the run-up bull market that we experienced. If you would have held for the past 5 years, you would have made money, approximately 10% per year. But if you're like a lot of people, you probably would have purchased it near its high, which was $113.51 on February 12, 2021. And of course, since then it's been going down. Here's a 1-year chart. If you would have held it for the past 52 weeks, you'd be down nearly 72%. And year to date, you'd be down about 28%. Obviously, that's much more than many measures of the broader markets, but not nearly as bad as many high-flying companies. Reason 2, very choppy earnings. When you're looking at earnings on various commonly used financial websites like Google or Yahoo, you have to be careful and make sure that the numbers that you're looking at are what you think they are and are really accurate and no mistakes have seeped in. Here's a screenshot from one of the financial pages from Yahoo. According to this, in 2021, they lost 1 cent a share. In 2020, they lost 5 cents a share. In 2019, they lost 8 cents a share. And in 2018, they lost 13 cents a share. So those are annual returns, and they're all losses. So I don't understand how the company is really claiming a profit. Here are the earnings from recent quarters from the Google site. Quarter ending June 2022, they had earnings of 6 cents a share. March 2022, they had earnings of 4 cents a share. December 2021, they had earnings of 14 cents per share. And September 2021, they had earnings of 5 cents a share. However, if you look at the financials provided on their website, you seem to get a different set of numbers. Again, some of the numbers being losses and some of the numbers being small gains. If you're interested in investing, you should always look at financials as well as considering future potential. Do your own research here to try to determine which are the best numbers for you to be considering. Reason 3, the company has very high price to earnings ratio. Here we see they have a price to earnings ratio of 72.69. That's the good thing about that is it does seem to indicate here that they're not losing money since this is a price to earnings ratio. However, 72.69 is extremely high. Can they sustain it? I think looking at the chart shows that they cannot. Reason 4, they have a reputation for being a cheating site. It seems much of their business is by utilizing a workforce in India who helps primarily American college students with problems that they have doing their homework. There's an excellent article in Forbes from last year that details a lot of issues with this company, in particular issues around cheating, especially during COVID when tests were being taken online from home rather than in proctored classrooms. Now, it would be great if people were not cheating, but I don't really care if people in college are cheating. However, when considering investing in a company whose business model rests in large part upon providing services to students, which could facilitate cheating, it should give pause to the investor. Not on a moral or ethical level, but on a practical level. And that's just something you're going to need to think through and decide on your own. Reason 5, they are an extremely risky line of business. Now, we're mainly dealing with higher educational system in the United States here. Despite the high cost of tuition and the high cost of textbooks, not a lot of companies are making tremendous sustained profits from providing educational services. Crackdowns by the Department of Education have led to the closing of many for-profit American colleges, and the ones that remain do not necessarily have a good reputation. There were a number of publicly listed Chinese educational services companies, which in the last few years have been closed down by the Chinese government for mainly ideological reasons. I would argue that many of the services that CHEGG provides through their monthly subscription can be found basically for free by almost any student if they just Google the correct words. And as far as textbooks, it's good to see that they're getting out of that segment of the business, but there could soon be a revolution in ebooks and online textbooks that greatly disrupt that market and provide that information to students for very little cost. Reason 6, they have formidable competition. They admitted in their investors deck that they have competitors such as Amazon and Google, among others. I'm not sure if Amazon is still renting textbooks, but again, my comments about the future of e-textbooks I think is relevant. And this company is not disrupting education. It's not a better format of education. It's in theory just trying to help students in traditional American universities. But if that help is simply making their lives a little easier because they're having somebody in India writing a paper for them or coming up with the answers to their algebra test, then that's not ultimately going to help somebody get the skills that they may need once they graduate and don't have access to that service. And along these lines, they've made a number of very expensive acquisitions which don't seem to have been paid off in the end from a return on investment perspective. Some of the business units that the acquisitions provided have been closed down soon after they were integrated into CHEGG. Again, that may be an indication that it's difficult to make money in the educational sphere and that their business strategy may have a number of practical problems. Okay, those are the 6 things that I wanted to bring up today. I've gotten some pushback from owners of certain stocks in the past. I encourage feedback, either positive or negative. I understand their frustration and that they hope that management will be able to turn the company around. I want the best for this in all companies. I don't want them to go down and I don't want people to lose money, but hope is not an investment strategy. If you own shares of the company, what should you do? Well, most likely you've lost money on it. Could it go up a little bit and recoup some of your losses? Sure, anything is possible. But my advice, and I'm not a financial advisor to somebody making YouTube videos, is that maybe you would be better off selling your CHEGG and putting it into something else. What would a better option be? Well, you'll have to watch my other videos that I've made recently to answer that. Okay, that's all I wanted to say for today. I'd love to hear from you. Please leave your comments in the comment section below. And if you disagree with me, please feel free to point out weaknesses in my arguments. Hopefully by now you subscribe to this channel and like this video. I would love it if you looked at my other videos. Hopefully click the like button on those and leave a comment, even a short one. All those things really help me out in building a following. As I always mention, this is not investment advice and I'm not an investment advisor. Just some guy on the internet that you don't know making YouTube videos that hopefully provide some entertainment, but I try to create entertainment that gives you a starting point where you can do your own research and potentially find stocks that might have some place in your well-diversified long-range portfolio. Since this channel is not yet monetized, if you want to help me out, I sell small collectibles on eBay. Things like old stock and bond certificates, coins and banknotes, stamps and postal items, and books, along with other things such as Masonic items. You can find my items on eBay with my username stock_tycoon. If you're interested in buying silver coins as collectibles or investments, I usually have some listed. If you're interested in investing in gold or silver as a commodity, I have a few YouTube videos that explain how you can easily do that, plus some of the pitfalls in doing so. I'm on Instagram at AnthonyRR Mills. You can follow me there. Thanks for watching and good luck in investing.